Welcome, everybody, to this week's Middle Class Investor. This is Seth Martin, your host. It is Friday, April 22nd, and we are looking at a chart of the S&P 500, and you can see, of course, that this week was an up week. We're talking about this week right here. And wow, the market, it just really was going higher, wasn't it? And really exceeded my expectations of how high it would go in this move up. I think the move is over, but certainly the market could kind of make its way back down to this trend line and then bounce from here and go higher. That's something I'm going to be watching out for. It's likely if we get a close below, if we get a candle next week that looks like that, where the close is below this low, then we're likely to at least make it down here into the mid 1975 area. I mean, we're going to have some sort of pullback into this mid range area, and then maybe we might see a bounce. But I think I was looking at this on the weekly, and one of the interesting things about this chart is this wick here from the high, from the previous swing high. So when I say previous swing high, I'm talking about this pivot right here was the previous swing high compared to this swing high right here. But what's interesting is this, let me erase this. See this wick right here? This candle is all wick. And you can see that I drew this 2099 line just below the close, or right there at the close of this candle. And you can see that this area is a very important area for resistance. Not a ton of bulls think that the market has much value above this close. And occasionally you can see this. This is, I don't know, this happens from time to time. It's just usually a very good signal, trend reversal signal. And so that's going to be how I'm going to be looking at it. Really the first real good clue is going to be, a bar that looks like that. And then we might see, some bigger bars after that, like so on and so forth. But we got to get through that first. We got to get that close below the low of this high day. And once we get a close below that, then that tells us pretty much that the buyers have dried up and the sellers have taken over. And that's what I'm expecting starting next week. Now, if we look at this on a shorter term basis, like a 9-month, you can see here's that area right here that, let me zoom in on this a little bit. This is that area right here that had the long wick, and you can see the market ran up into that area and then made a kind of couple dojis here, and then it started to sell off. Now it sold off, found support, and rallied back up pretty good today. I mean, we basically had the open and the close were roughly the same today. So there's a whole lot of nothing in today's market. But wow, what a move up here. I think this is like 16% or something like that. So anyway, if you look at the Wilshire, of course it had a pretty big sell-off today. And one of the reasons we've been looking at the Wilshire is just a broader set of stocks. I mean, it's 5,000 stocks in the Wilshire, and you can see that's a pretty that could be called a bearish, not really a bearish harami. maybe that's an engulfing pattern. If it were completely, if it completely covered this candle, it would be an engulfing pattern or bearish harami. But you can see that the market, you had quite a bit of movement there in the Wilshire. There's something about that candle that's not quite right. I don't know what it is, but let's go ahead and get off of it for now. If we look at the NASDAQ composite, you can see it didn't have as strong a day as the S&P 500. It kind of it gapped down and it kind of stayed below all day. That's pretty bearish. If you look at the Dow Industrials, it was probably the strongest, although that's not saying much. But it does make sense for it to be the strongest because when the market starts getting defensive, buyers move into defensive issues. They sell things that are a little bit more, risky, and they move into things like Honeywell and GE and stuff like that. Travelers, Dow 30 type issues. Let's go back to a weekly and let's look at, why don't we look at the VIX since we just got off the S&P 500. So the VIX is still low in the range here, and it's kind of just chopping around through this zone right here, and it might do that for another week. I mean, it might do that again this coming week, or we could see volatility expand a little bit to the upside, maybe even break out of this box. And if it does break out of this box, it'll probably rally pretty quickly. So I think it's going to chop around in here for a week or two, maybe at the most, and then start to break out of this box. Let's look at the bond yields, the 10-year Treasury. You can see it had a really pretty good day or good week this week. It's a pretty good move. And so we did get a close above, this is our low candle right here. So this could have been, our first move out and our first pullback after the first move. And then we should be, if that's the case, then we should be seeing yields go up pretty dramatically. And that in itself could cause stocks to fall rapidly. Because remember, the whole basis of this recovery has been inexpensive borrowing. And of course, if the Treasury starts to go up because Saudi Arabia starts getting rid of bonds or China is getting rid of its bonds, I mean, basically the whole world is going to be at some point selling U.S. Treasuries. And if they do it in a pretty big way, we're going to see yields move out pretty fast. So this is not a new story. You guys have heard me talk about it before, but be careful with bond funds. And just as a refresher, bond funds, because they're in a fund, there's no maturity on the bond. So the bond fund is made up of a bunch of bonds, but because there's no maturity, you can never really hold a bond until it's worth face value. So you can lose a lot of money in a bond fund because it's I forgot the term, but basically it's valued every day for what the bonds are valued. So if I go buy let's say I go buy a $100,000 bond, and the face value of the bond is $100,000, and let's say I pay $65,000 for it, but let's say it goes down to $35,000. Well, and let's say it's a 10-year bond, I can hold it for the remainder of the 10 years, and eventually it'll pay at it'll pay $100,000, and I'll make 35% on it. But inside of a bond fund, that loss is experienced um, almost like in perpetuity. There is no maturity date on the bond fund, so just be careful with that. It's not the first time I've mentioned it. Probably won't be the last. Just want you guys to be careful with that because bonds are generally perceived as safe, and they're not necessarily. Well, they're definitely not safe in a rising interest rate environment. Okay, well, right now I'm looking at Germany. You can see Germany turned up this week, pretty good, and broke this downtrend line. So that's probably a positive for Germany. Germany's definitely the best looking house on the street kind of thing. So keep an eye on that. Maybe wait until you get a pullback into this 2450 area to look to go long Germany. Excuse me. Let's look at Japan. Japan. What's interesting about Japan is their economy is really starting to stink, but their market at this point looks like it wants to go higher. Maybe it will, maybe it won't. This might just be so. To the untrained eye, the market just looks like it's just doing like this all the time, right? It's hard to really tell what the heck is going on. But if you try to see a pattern here, like an Elliott wave, you can always look for the long move. Where's the long move? Like right here, you had this long move right here. Well, the long move here is right here. So you can kind of see, where I've got kind of a line, back up. In other words, you can kind of see this, 5-wave looking thing. And then this is counter trend, okay? And then you've got like another one right here, right? You got another kind of 5-wave deal, right? So this could be a 1 and a 2 and a 1, and this could be a second 2. So as long as it doesn't go above here, this area right in here, then this could be a 2, and the next move could be substantially lower. So what I would do is I would look for a sell signal here with a stop above here. So in other words, if you get another, let's say you got a candle that looks like that, looks up, and then maybe we get a candle that looks like this with a long tail on it, like something like this. And then this is a sell candle. So let's say you got a candle like that. Well, now you might want to short Japan and play for a move down in this area down here below this low right here. So always see if you can find kind of the big move. The key is it's got to be, it has to be a big move and then kind of followed by a smaller move that either sets a new high or a new low. So what do I mean by that? If you look at this as well, shoot. Let me do this and this. This one right here, this move is a great example because here's your long move and see it rally but then went to a slightly lower low. That's pretty typical of a motive wave. Whereas this one is a little bit more confusing because you've got this long wave here, but it didn't pull back and make a higher high. So this could all be corrective here. So, which makes a lot of sense. If this is corrective, then these are your motive waves in the direction of the trend. But the only other way to look at this is, if this market goes above these highs right here, then all bets are off. It's not a short. Look to go even longer than where you are right now. I know that's confusing, and I'm not trying to confuse you. It's just, we could spend a whole YouTube channel talking about trend and patterns and the weight of the evidence, as Dave Johnson used to say. I think that's really, well, we can look at the 13-week yield. That's the 13-week Treasury yield. That's what we've been using to predict whether or not the Fed is going to raise rates. And they're, the talking heads are talking about, well, the Fed's only going to raise rates once this year. Well, I can just tell you now, I don't know how many times they're going to raise rates, but if this starts to move out like this, they will be raising rates because they won't let the market get too far away from their recommended rate. I mean, they're trying to maintain the perception that they set these rates. Well, that's going to be hard impression for them to maintain going forward, because people are going to ask them things like, why are you letting interest rates go so high? What can we do about these high interest rates? And, the answer is nothing, but they want to be perceived as being able to do something. So they're going to continue to keep up that charade as long as they can. But I don't think this move here is big enough for us to expect a new move in the Fed. I would say it would have to be above these highs and looking strong for them to come out and say, oh, we need to raise rates. But, we'll just wait and see what they do. It'll definitely be interesting to observe as being like an informed observer, as opposed to somebody that just doesn't know what the heck the Fed's doing or why they're doing it. A lot of what the Fed does is, just to cover up the fact that they're not really in control. They want to be perceived as in control, but there's no evidence that shows that the Fed really controls anything about, long-term interest rates or just anything about the economy. Let's switch over. I'm not going to be using NinjaTrader today, but I was having some sort of trouble firing it up. So we're just going to go over here to the toss charts. I'm going to do that. And of course, here's the dollar. And, today could be a turn in the dollar. But if it is, then we're probably back to some sort of triangle, is my guess. The reason I say that is because this low it's slightly lower than that low, isn't it? But it's not lower than that low. So if we back up here and look at these highs and lows. So here was a low, we came off the bottom to a higher low, pulled back to a higher high. And then so what we're expecting is A, B, C, D, E. So we're expecting, this to pull up into here, pull back about halfway, and then really have the market really thrust that dollar upward. Let's look at gold. Here's the long bear market, that we keep talking about. And you can see gold has kind of reached a place where it wants to pause, but it's likely really to move up into this yellow box before we see some sort of rollover in gold. And you could probably see, this is probably the A wave of the ABC, and B could be a lot of stuff taken out of context, and it probably will be, because it's hard to figure out sometimes these commodities and their price moves. I think the most interesting thing about commodities right now, more than whether or not the U.S. Treasury is going to inflate the dollar away, but I think one of the most interesting things about currencies is how everybody seems to be wanting to devalue their currency. And nobody seems to be upset about this. I mean, it's just, I don't know, it's just really bizarre. As if somehow making your currency less valuable strengthens your economy. Now, there is a nominal increase in growth. So the thing about it is everything's about growth, 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 growth. Well, one of the things that's in growth, or GDP, is the cost of things. So if you're looking at the total production of the economy and things are increasing in value due to inflation, well, that makes GDP go up. So typically what you do is you look at GDP and you subtract inflation. Well, if the official inflation is 1% or 2%, let's say it's 1.5%, but the real inflation that Americans are feeling is more like 5 or 6, then you've got a nominal increase in GDP, but maybe it's a net decrease in standard of living and purchasing power for Americans. So I'm getting off into the weeds a little bit here, but it's just really frustrating to me that somehow we've come to believe that, oh, we need to lower the value of our currency so our exports are more affordable. Well, okay, but it's not just about exports, it's about imports as well. I mean, in order to be a prosperous economy, you have to have exports and imports. And okay, so your exports are less expensive compared to for buyers outside the United States. But then the imports that consumers have to buy, they're more expensive. So really, when you look at exports and imports, they really are supposed to kind of cancel each other out. You're just left with a net benefit of, some countries have resources. Some countries, like the United States, have a huge capital stock, and the workers are very productive. Other countries, all countries have, their thing. The big thing that the United States has is we have a huge capital stock, so our people are very productive, and then we're also very productive in farming. And so that gives us huge export capability in that area. But then we're a consumption society. We believe, some of us do anyway, that consumption is the key to GDP, and of course it's not true. Saving and investment is also part of the equation in GDP, and saving and investment have been really, really lagging the last really 15 years. So it's a complicated thing, but you're starting to see some cracks. Like if you look at Japan's really been devaluing their currency, and this negative yield and stuff like that. And what's happening with Japan? Their economy's rolling over. They're not. It was nothing. They just wasted $1 trillion for nothing. And so, all this voodoo stuff. We just need to get the government, kind of off our backs and get people to producing, with the way they want to produce. I mean, people want to produce for their families and for their businesses. They're not there to produce for the government. So anyway, but the commodity stuff, the interesting thing that's happening there is it's starting to cause problems with these commodity countries like Saudi Arabia. I mean, their people are, because they don't really have any other kind of productive capacity, they rely heavily on oil. Well, while the good times were good, they're doling out money all over the place in Saudi Arabia. Now that good times aren't so good anymore, these people are starting to get upset because the government doesn't have the money to give to them the way it was before. So you see that with Venezuela. I mean, Venezuela, has had problems even before commodity prices started to fall, but now those problems are even more exacerbated. So it's just interesting to see how these commodity countries, it kind of reminds me of during the financial crisis when all the housing values went down and the city governments were used to spending based on those inflated revenues they were getting on inflated houses. So all this money was pouring into city governments, and they're raising people's pensions and doing all kinds of, stuff like the good times were never going to end. And then the housing market crashed, and then you start hearing about city governments, needing to file bankruptcy and stuff. So it's the same old thing. I mean, a lot of this stuff is just, it got too frothy. There's going to be some liquidation. There's going to be some defaults, and that's going to have a deflationary effect on commodities and oil and things like that. It's going to cause money to flow into the dollar. But that's what these low commodity prices are telling us. They're telling us that that's where we're headed. Oil's going down because we overproduce. But we overproduce because we had high prices. So the cure for high prices is more production. Anyway, I just start listening for, how some of these countries are starting to have trouble. I think it's very, very interesting. And it's just the same thing happens over and over again. So anyway, that's gold. Of course, long term, I think gold's probably coming down to this area because of deflation. There's a macroeconomic story to gold too, and I'm not that familiar with it. I need to find out. I'll bone up on it and tell it to you guys next time, because it's kind of interesting that there's other reasons why gold is going down that have to do with countries that save a lot of gold and things like that. But I'll bone up on that, and I'll tell you about it next time, because it is kind of interesting. The euro US dollar, the euro to me looks like it's started to roll over and make this move down. You can see here, in fact, this is probably a great place to short the euro. Basically, I need to kind of shift all these curves over, because this right here, this line right here is this. So I'm expecting this to come down into this area and then work its way back up here, and then boom, have the euro sell off out of this continuation pattern to lower lows. And that is going to cause some stress in Europe and in the United States for that matter. So it'll be interesting to see how that plays out. Oil's been rallying, which is, that's something, if you've been listening to this YouTube channel, we've been expecting oil to rally. I talked last week about it's at least going to go to this this $47, almost $48 area, but could move up into this yellow box here around $50 to $53 before rolling back over and making another leg lower. Let's look at the US dollar JPY. So, I haven't been following this one as closely, but it's reversed here recently. And I would say that, you'll see the yen US dollar move up into this area right here for the time being. So it's got some room to move here, probably into this declining 20-day moving average, or what will be maybe somewhere in between the declining 20-day and the declining 50-day moving average. This is a great short setup too, by the way, where it crosses down through here. Here, let's zoom in on this a little bit. I used to look for these kinds of setups on a 60-minute chart, because they would happen more frequently on a 60-minute chart than they would on a weekly chart, obviously. But this happens all the time, where you break down through, these levels, the market comes back up and tests it, and when it goes back through again, it just falls. So it really did it kind of twice here. It fell through, retested, fell through, retested, and just collapsed. So, you might look for that maybe put a 50 and a 20-day moving average on a 60-minute chart and look for these kinds of setups. They're there all the time. That's really about it. Let's see, oil, silver, euro. Yeah. Yep, that's about it. So anyway, what could happen next week? Well, anything can happen in the market. That's what I learned. When somebody, if somebody says, "Oh, the market could go down, 1,000 points next week," and if you hear somebody say, "Oh, the market could never do that," just know that that person doesn't know what they're talking about. It absolutely can do that, and part of having some success in the market is understanding that the market can do anything. It is possible for it to do anything, and you should be prepared for it to do anything. That's one of the reasons you use stop losses and things like that, because if it's pulling back, you just don't know how far it's going to pull back, and there's just no way to know. So you can make probabilistic estimates, but that doesn't mean that it has to stop there and bounce, and of course you could lose a lot of money. So anyway, I would say next week you should see this continue to the downside, at least down to this descending trend line, and then maybe it bounces there and comes up, or maybe it just continues to fall down through here. I think a likely area to stop in is around this 2025 area, below these lows here. So, don't be surprised if we get like in this area and bounce. So we sell off down to this area, bounce, and kind of bounce back up like that, and then sell off hard again. So now all that's not going to happen next week. I mean, we'll be lucky if we get all the way down to here next week. So we've got a multi-week, multi-move week that's at our doorstep here. So that's probably what you can expect. And I say again, if you're in your 401k, this is a great time to move it to cash. Great time. You're just not going to get much better than this. And there's hardly any upside from here, but there's a ton of downside risk. So it's a great place to exit the market. You always want to exit the market where it's fairly quiet. You don't want to exit the market when the market's moving like this, because there's what's called slippage in the market. So there's the price you want to get out at, and then there's the price you actually get out at. And the easiest way to see this is over earnings. Let's say a stock's trading for $100 and you're long the stock over earnings. And let's say you decided, well, if it goes below $95, I want to get out. So you set a stop at $95. Earnings come out and the stock gaps down to 80. Well, guess what you got filled at? You didn't get filled at 95, you got filled at 80. That was the next available price. So it's always better to get out during quiet moments in the market. The slippage is a lot less, and there's just a lot fewer losses there. All right, everybody, that is it for this week's Middle Class Investor. I really want to thank you for coming in. And if you have any questions, or if you want to see us talk about something in particular, just make some comments in the YouTube channel, and I'll be happy to incorporate those in our YouTube sessions here. All right, until next week, I hope everybody stays safe, works hard, makes some good trades, and just be careful out on the roads. I know in Houston we had a lot of rain. A lot of people almost got flooded out. Just be careful anyway on the roads. The roads are dangerous, and of course they're a lot more dangerous when there's high water and a lot of rain. So be careful out there. Take care, everybody. We'll see you next week. Bye.